Okay, so before I show the solutions, so Timmy, what did you get for your Q1 AETR, or your Q1 ETR that shows up on the 10Q? A -2 on your Q1. You're doing your Q1 10Q. 30% sounds more like it. Okay. So Jenny, what did you get on your Q2 10Q rate? Okay. Uncle Sam, what did you get on your Q2 rate? How much? On your Q2. Okay, but when you show your 10Q, what do you think the rate's going to look like? Okay, but you just said it was 30%. Okay, but pretend you're the CFO, and now you've used too many words, right? So you need to make it simpler. Like, what's the CFO going to see? He's going to see it including the items, right? Okay. So the CFO is going to look at the income statement. He's going to see a tax provision, and he's going to see PBT. And when he takes the tax provision and divides by PBT, what rate does he see? Or she? Mike, what do you think?
Doesn't the CFO see the ETR 30%?
I don't know. Other Mike with the smile, what do you think?
I don't know.
You guys are killing me. I'm going to have to give another exam in this class at the end. Carrot and stick. You need more stick. Grant?
7%?
70%. Okay, you guys are all over the map. All right. You have... okay. So let's flip to the solutions and have ourselves a look. Okay. Okay. So we know that the annual AETR every quarter is 30%, right? Because we use some pretty simple assumptions in terms of what our annual effective tax rate was going to be every quarter. We assumed that our forecast was static, our tax rate was static, there was no perms. It was really easy, right? So unless something weird happened, our rate was going to be 30% every quarter, right? So now, when we get to Q1, we're going to take 30%. We're going to take our year-to-date income, right? We're going to take year-to-date income of 20 times 30%, and that will equal $6,000. And when the CFO sees the 10Q for Q1, he or she will see the $6,000 of P&L provision divided by the income for that period, and the effective rate that the CFO will see will be 30%, right? For Q2, we're going to take our ordinary income. We are going to exclude this, right? This $40,000 of income excludes this $50,000 one-time loss. We're going to take $40,000, multiply it by our annual effective tax rate, excluding one-time items, and that will get us $12,000. So that's our 6-month provision, excluding the effect of one-time items. I don't have an effect to the one-time item. It's a non-deductible expense, right? So once I've calculated my provision on ordinary income, there's nothing for me to add to it because there is no tax effect of that expense. The tax effect is zero, right? It is a non-deductible expense. So that means my provision, even including the one-time items, is still $12,000, which means for Q2, it's a $6,000 provision, right? But the CFO is going to see for the quarter, right? The CFO, when he looks at the ETR for the quarter on the Q, that person's going to see 6,000 in the numerator, but the denominator is confusing, right? Make sure I capture this. The denominator is going to be a combination of items. So we know that for Q2, we know that our quarterly income is $20,000 of kind of normal operating profits, offset by $50,000 of a one-time loss. So that means for the Q, our denominator is actually going to be a negative $30,000. Right? So that's just strange, right? Because now for the Q, the tax rate is going to be basically a negative 20%, which doesn't really make any sense, right? And the reason is that you've come a long way from taking this 30% assumption over here and trying to understand, well, how do I segue from 30%, down to this 20% line? And the answer is it's complicated, right? I mean, we just have one item in here, but that item affects both the denominator of the quarterly ETR calc as well as the numerator, right? And its effect on the numerator is zero. But the problem is by throwing in this one-time non-deductible item, you've really disrupted the relationship between the numerator and denominator on a 10Q reporting basis. So you see this all the time when companies have goodwill impairments. So if you went back to Q4 of '08, when the financial crisis hit and the stock market tanked and everyone booked goodwill charges, people's tax rates all looked like this. They looked just wild because they had these large denominator losses that had no bearing on the numerator. Okay, so is that making sense, how mechanically I did that? A little bit?
Can you explain the 50,000 and the combination of that to 20 out of non-deductible?
Well, remember, if you're the CFO is not going to differentiate between this being ordinary income and my $30,000 of what shows up at the bottom of the income statement for the Q, right? To the CFO, it's very likely that there's just one income number for the Q, and it's the total income number, which is the $30,000. And so the education that needs to happen is, well, hey, we do the provision really in two pieces. We do the provision once for the ordinary income element, the usual, the normal stuff, and then the second piece of our provision is the tax effect and the denominator effect of these one-time items.
So 20,000 is booking.
The 20,000 is operating and what I'll call normal income. Okay?
And 50,000 is something you're not able to deduct for income tax purposes.
It's a one-time item that really is distinct from operations. It's unusual. And for the quarter, the P&L doesn't differentiate between usual and unusual stuff. It's all in there. So for the quarter, your P&L will show a loss of $30,000 because it's reflecting both the one-time charge as well as the normal business operations.
I guess I'm getting someone confused on why when you're not able to take an expense, why that figure on the other side doesn't go up 50,000.
Yeah. So let me do another example. Sorry, I'll say it one more time. Yeah, this 40,000 is exclusive of that 50,000. That's the assumption. Okay, so let me just do another example and just kind of freeform it for a bit here. Okay, so let's say that we are in country A and country B. And let's say for the year we think our PBT is going to be 1,000 and 200. Or let me just make this like that. Okay, so if I was, okay, we don't want that. Okay, so if I was calculating my annual tax, I would take my forecasted annual income of 800 times my tax rate. So I would get a 320 annual provision and a 20 over here. Okay, so let's say that this is what I thought my annual forecasted tax rate was going to look like. I had two jurisdictions, it's kind of a blended rate, there's a bunch of things going on, and and in Q1, let's say that I had global PBT of 200 bucks. Okay? So my Q1 provision would be my year-to-date provision of 200 times my annual effective tax rate of 34%. And for Q1, I would have a provision of $68. Okay? Easy. Okay, we good with that?
Yeah.
All right. So now let's say we go to Q2, and we're going to do this all again. And let's say now for the year, my profits have shifted a little bit. I'm going to make a little less money in country A and a little more in country B. So I'm still making 1,000 of annual profits, but my mix of income by jurisdiction has changed a little bit. Okay? And as a result, I have a 31% rate instead of a 34% rate. Okay? Okay, so now let's assume that, I'm just going to hide this over here for the second. Let's assume that my Q2 year-to-date global PBT is 300. Okay, which means I had 100 in the quarter. All right. Now, let's say also in Q2, I had a restructuring charge in country A. Oops, that's not going to help that. Okay. Let's say I had a restructuring charge in company A of, let me try to make the math somewhat easy, of 40. Okay, so not included in the 300 of year-to-date operating income is a 40 charge related to restructuring. And that charge is fully deductible. Okay? Say we're moving out of a building and we have to pay the landlord amount to exit our lease. Okay? All right, so now the question is, well, what is our Q2 provision? So our Q2 provision, I'm just going to slide this back into the screen. The first thing we're going to do is we're going to do our year-to-date provision on ordinary income. Okay, this is a little unstructured the way I'm going to do it here, but our year-to-date income on ordinary income is $300, and our annual effective tax rate, we think, is going to be 31%. So just with respect to ordinary income, I would expect a 93 provision on a year-to-date basis. I already booked 68 last quarter. So that means for this quarter, just related to ordinary income, I need a tax provision of 25. Okay. Okay, so this is on ordinary income. Ordinary income tax expense. Okay. Okay, so now I'm going to add the tax effect of discrete items, and I'm assuming for this purposes of this example that this restructuring is a discrete item. Okay. So I have a $40 expense in country A with a 40% tax rate. Okay. So what's that going to do to my provision? If I have a $40 expense and it's at a 40% tax rate, what is my provision for the year going to be on that one item? A 16 benefit, right? So I'm going to book the effect of that 16 discretely. So my total provision for the quarter is the quarterly provision on my ordinary income plus the one-time or non-recurring effect of my discrete item. So my provision for Q2 is 9. Okay. My PBT for Q2, what shows up on the 10Q, is going to be the year-to-date PBT of 300 minus my Q1 PBT of 200 minus my one-time expense, or my discrete non-ordinary item, of 40. So it's 60. Okay, did you guys see how I got that? Yolanda, did you see how I got that? Okay, so Yolanda's question is, when I booked my discrete item here, I think, I took $40 of expense times a 40% tax rate, not times a 31% tax rate. But what I was trying to do is calculate a tax effect incrementally on that country A charge, as if it had nothing to do with this blended rate that I'm applying on ordinary income. Because I know that this $40 charge, it relates just to country A. There's not a mix of income thing here where I need to blend that amongst multiple jurisdictions. I know in my example, I labeled it as country A on purpose to say that that charge has a country A tax effect, but not a blended rate tax effect. Okay? The 40 is not in the 300. The 40 is separate from the 300. The 300 is just ordinary income.
So you said it's considered discrete items. You did not put it in your PBT calc. It's not part of that factor. You also said something as far as this is a fully deductible, whereas in the other example it is non-deductible.
Right. So this yellow shaded section is me calculating the provision on an ordinary income basis. Okay. My 300 of year-to-date income is ordinary only, excluding the non-recurring stuff. My tax rate is my annual effective tax rate that I've estimated, excluding those non-recurring items. And therefore, my 93 provision is my year-to-date provision on ordinary income. This was my Q1 provision on ordinary income. And so this is my Q2 ordinary income tax expense. Okay. When I book a discrete item, I book it as if it's the only thing out there. There's no mixing it in with everything else that's going on for the year. As if it's totally separate. Okay. And as if this thing was the only item of income or loss that we had was a $40 restructuring, we would book a 16 provision benefit unless we needed a valuation allowance. Okay, because it's at country A, it's a country A's rate, simple as that. So again, to get my PBT, so this is PBT not just ordinary income, but this is all, right? This is ordinary plus the unusual, is what I'll call it. Okay. And again, your CFO is not going to recognize some. If you tell them, well, what's my ordinary income? That's a term that the CFO is not going to understand. That's a tax provision term. So you need to understand that the Q2 provision is partly this yellow shaded item, which is the kind of normal ordinary income. And then added to it is my discrete item, which I really calculate totally independently and totally separately. So getting to your 9 of total Q2 provision is the combination of those yellow and blue sections. But when you're the CFO, you're going to look at the tax provision based, or the effective tax rate rather, as my tax expense for the quarter, which I've gotten to in a pretty eventful way in this calculation, and divide it by PBT for the quarter. And this is going to be all of the income that shows up on the 10Q. And our tax rate is 15%. And again, that 60 of PBT, what that represents just by formula is my 300 of ordinary income for the year minus the 200 I had in Q1, which means in Q2 I made $100 of ordinary income. And offsetting that $100 of ordinary income in Q2 is a one-time $40 charge to get me to $60 of PBT for the quarter. Okay, so when you look at the face of the income statement, you will see 60 of profit. So that means our tax rate is 15% for the quarter. Okay, and so if Don's boss walks in and says 15%, that is acceptable, right? That seems like a low rate. The next question they might ask is, well, why is it so low? That seems almost too low. That's unacceptable, right? And so if somebody said that to you and they said, well, the rate is 15%, why is it so low? What would you say? What would you say, Timmy? One-time activity. What does that mean? The one-time activity was a 40%. Well, how does that make 15% the right answer? What's that? The 15% is just this quarter. That is correct. I know, and the question is why? Why is it so low? Why isn't it more like 30%, 40%, or something like that? You're good. I don't know why it is, but I'm going to go ahead and take credit for that. Can you say it one more time? Okay, so Shuki picked up on a good item. First of all, the answer is there's multiple things happening. Okay, the first thing is that my rate at Q1 was 34%, but now it's 31. So the fact I have a lower Q2 rate, in part, is attributable to the fact that my annual rate is dropping. And I have that catch-up effect that we really started the class with tonight. Okay? So some of that is the 3% change being caught up on that $200 of income that we booked in Q1, right? So if you just think, well, gosh, I over-accrued on $200 of income by 3%, that's 6. But I only had 60 of PBT for the quarter, that's a 10% rate drop just because of that catch-up mechanic, right? That's pretty severe, even though it seemed kind of subtle, right? 34 to 31 is not a big swing, but the problem is in this example, and I was just kind of making it up as we went, there's only a small amount of income in Q2, so any change over that small income amount looks big, right? If we made Q2 income 260, that effect would be much more subtle. And so what you, just seeing that, what you start to appreciate as part of quarterly provisions is that there is a lot of math, right? You need to be good at math, good at understanding the levers so that you can quickly say, oh, that little thing we just changed, it will impact the rate significantly, and here's why. Okay? So Shu King's right. That's one of the factors that my rate is so low, but that doesn't explain how it was 34% last quarter and it's 15% this quarter. That might get you like half the distance. Right. Okay, so keep going. So I'm a CFO, and you just told me that the $40 one-time charge was in country A, which is at 40%. And so why do I care about that? Right. So I guess the way I would describe it, using slightly different words, but what you said is perfectly right. This 31% right here, my annual effective tax rate that I'm planning on for the year, this right here, this assumes that every dollar of income I have is taxed at a blended rate of 31%. And if I get more deductions in country A at a rate of 40%, right? That's a good thing. I want my deductions at the highest rate possible, and I want my income at the lowest rate possible. So if I have more deductions in country A, yeah, what's going to happen is, remember, this 31 is without my non-recurring items. But if I had plugged that in, like let's say for the year, now I'm not expecting 700 of income, I'm expecting 660 when I throw in my one-time item. The rate, it doesn't look like it dropped just because it's rounding, but it did drop, right? So let me, oops. Okay, so it's 30.6% here, now that I factored that in. And if I go back to making that 700, it's 31%. So when I put more expenses in my country A column, that's going to move my mix of income favorably. So my rate drops on a blended basis. But when I book that effect discretely, I get all of that incremental rate benefit at one time, right? Because when I make that change here in my annual rate, it's kind of subtle, and in theory I would spread that throughout the year. But that's not how I do a discrete item. I do the discrete item separately. And that entire change between 31 and the 30.6 on an annual basis, I take that whole effect into Q1. Or sorry, Q2 in this example. Okay.
So I'm still kind of tripped up on this term. You said it was $50,000 in the example that we had. It was $50,000 non-deductible, and this year is fully deductible. I'm not sure what we're doing different here.
Right. So you're going to make me do another example, is that what you're telling me?
No.
I'm joking.
That's the answer that you
So items that are pulled out and recorded discretely sometimes can have a tax effect, like in my example that I just ad-libbed there, where there's a charge that's fully deductible. It just happens to be deductible at a rate different from our annual ETR.
Right.
Or items can be completely non-deductible. And the point is that you account for them the same way, in that, just like in this yellow and blue shaded section here, you first do the provision as if that non-recurring unusual item doesn't exist, and then you incrementally layer on the effect on an annual basis of that discrete item.
So what if there was a huge, I don't know, like a huge fine or something like that?
Right. So then the tax effect of that huge, so let's say that $40 charge was a fine.
Right.
Okay? So what would be my discrete tax effect of paying a fine of $40 on a one-time basis in country A? So let's say the facts are exactly the same, except this restructuring is a fine. So, Shoe King, you're on a roll. What do you think? Good guess. So if I pay a $40 fine, there is no tax benefit. There's no tax effect whatsoever, right? So my discrete provision effect is 0. Right? I'm not going to debit or credit my payable for that. I'm not going to debit or credit my deferreds for that. So there is no provision impact of paying a fine. It's a 0 provision expense or benefit. But my denominator, my PBT on the 10Q, is still 60. It still reflects that $40 charge, right? Because that's a real charge. So now my PBT for Q2 has shot up. And now if the CFO said, hey, that's ridiculous, why is the rate so high? Now the answer is it's still multiple things, right? It's still the fact that the annual rate went down from 34 to 31. That's actually keeping the provision relatively tame. But then you'd say, hey, the reason the rate really went crazy is you recorded this large non-deductible expense, which is not a way to manage the rate, right? That's going to hurt the rate. So if, for example, we kept our income assumptions the same, 800 and 200, so now our 34 is still 34, but we booked a non-deductible one-time charge, my rate goes way up. And what you'd say is, hey, look, on the $100 of operating income that you had for the year, right, without that discrete item, you had a $34 of expense, which is exactly what you would expect, right? You're going to have 100 of Q2 income, a 34 expense, a 34 rate, everyone's happy, super normal. But it's not until you change this by putting 0 provision impact in the numerator because of the discrete item, but the denominator starts to sink, that causes the math change.
So the reason why an example went negative is because it was such a large change that it actually went PBT negative.
Exactly. And a lot of times when you see goodwill impairments, they're humongous compared to operating profits. And so back in Q4 of 08, when everyone was booking those, they had really large losses in the quarter that just dwarfed their operating results. That was very common. Okay, you with me now? You guys are like, make it end.
So actually, does it go like, towards infinity and then all of a sudden flows towards, and then it goes negative and all of a sudden it's the opposite?
Yeah, it's terrible. There's times when your denominator, like if we made the fine in country A not 40, let's say, but let's say we made it, 95. Well, now your tax rate's 680%, right? And the reason is you had $100 of operating profits for the quarter offset by a $95 non-deductible expense. So your PBT on the 10Q P&L is $5.
So if you made it 101.
be negative 3,400%. Yeah, so this happens. In fact, one of my buddies worked at a software company that has since been eaten up by Oracle, but his tax rate for one period was over 1,000%, largely because of this.
Because you're really close to zero.
Yeah, just small denominator. Yeah, and this is what's happening with Amazon a bit too. I mean, I don't know if you guys spent time looking at their 10Qs, but their PBT is relatively modest compared to a lot of the numerator things they have going on. And their PBT is an interesting thing, just given the life cycle of the company in terms of like where they're trying to expand and where they're spending money. But yeah, their small denominator relative to the magnitude of the numerator is causing problems. But it is math, right? I mean, oftentimes in this class you've been learning about accounting methodologies and how the theory of accounting works for tax accrual purposes. But this is math, right? You really have to just wrap your head around how do the mechanics work, and let me start thinking like that.
You can't just tell a CFO because you have a really small denominator.
Right. We have in the presentation we give one of the largest companies I work with. We give the CFO a deck every time we run a new turn of the annual forecasted expense, and there's a page in the deck that explains to him the denominator effect. And at that company, it's meaningful, and so we'll show, hey, if you change the denominator by 100 million without changing any of the perm items, here's what it will do to your rate. Just because they're hovering in a small number or smaller than people would normally think for a company that size. Okay, we good on that one? You're not going to make me do another example? Okay. So I want to cover one more concept. And okay, multiple jurisdictions. Okay, I did that example the way I did on purpose because it's maybe a better lead into this one. When you have multiple jurisdictions, and specifically lost jurisdictions, things get really tricky. Okay? And this is a bit of a trap for the unwary, because so far what I've told you is, and what I showed you in that prior example, is that you just blend everything together. Right? If you have two countries at different tax rates with different amounts of income and tax, you just kind of mesh everything together and use one big global ETR. Right? And that's the general rule, but one of the most important exceptions is you don't do it that way when you have multiple jurisdictions and one of them is a lost jurisdiction. And when I say lost jurisdiction, what I mean is it's a jurisdiction in which you lose money and you can't book any provision benefit for it. And the reason you can't book a provision benefit is because you have a valuation allowance. Okay? So in country 1, you're making money, you're profitable, you're paying tax. In country 2, you're losing money and you're never sure if you're going to make money, so you don't book a benefit for it. Okay? So that's the fact pattern. Okay? All right, so in this example, company T operates in is subject to tax in jurisdiction A and B. And as you can see here, A is country A, we're losing lots of money, and in country B, we are making lots of money. No perm items. We don't expect a benefit to country A losses. And the tax rates are 30 and 40%. What is our AETR? Okay. So here, and this is the cite to the rule, so this is our solution. When you calculate your AETR, remember I said you do your provision in two pieces, right? Kind of that ordinary income piece and the discrete item piece. When you calculate the ordinary income piece, you need to keep this paragraph in mind. So in the old Fin 18 guidance, Fin 18 had paragraph numbers, and paragraph 22A was this rule. And it basically said that you should exclude jurisdiction A, because jurisdiction A is a loser, right? It's losing money and you can't benefit the loss. This is a loser country. And so instead, you look at the provision, the AETR, only with respect to country B. Okay, and country B was going to make $800 for the year and have a tax rate of 40%, so this would be their provision. Okay. So now, when you calculate your provision every quarter, you take the 40% AETR and you multiply it by year-to-date income, not for everybody, but just for country B. Okay? And so in this example, country B makes $200 in Q1. You're going to take 200 times the 40% rate to get you an 80 provision for Q1. Okay? Hang tight for just a quick second. So you do all this as if country A doesn't even exist, right? You came up with the AETR without country A. You multiplied it by income without country A, just country B. So you get an 80 provision. Now your problem is when you look at the 10Q, the 10Q is going to show 80 of expense divided by PBT of 150, because the PBT on the P&L doesn't get to exclude the loss jurisdiction. It's everything, right? So it's the 50 loss plus the 200 profit is PBT. But when we calculate our provision, we really do it just for the profitable countries or the non-loss jurisdictions. So there's just a dynamic here that's really funky, right? And if you go to Q2, you'll see that Q2, the rate actually goes up compared to Q1. And the funny thing about that is country B's profit is the same. Country B's provision is the same. The only thing that differs is global PBT shrinks. So as global PBT shrinks but our provision stays the same, our rate goes up. Right? It's math. This is exactly what happened in that Jerry Yang example that I was telling you about. We had that catch-up effect, plus we had a lost jurisdiction issue, and it was just math, right? Simple little spreadsheet would show it. The problem is taking those rules and explaining them to somebody who wants it to be more logical, right? Okay, so do you still have your question?
Yeah, I'm not familiar with paragraph 22A, so again, like the United States be jurisdiction.
22A basically says, in any jurisdiction, which is really a separate tax, tax-paying jurisdiction.
It could be a state, it could be a country, it could be.
Absolutely. So if you have a loss with no benefit, not even $1 of benefit, so it could be Ireland, it could be the U.S. I have a client that is a household name that they their provision in the U.S. they lose money, but in all their foreign countries they make money. So their AETR is all for the foreign countries, and their country A loser is the U.S. And it's just based on what their operating model is doing at the moment. It's not really the long-term plan, but that's where they're at now. The whole reason that this rule exists this way, this often gets asked, is, well, why do you do this, right? Why do you exclude these lost jurisdictions? And the reason was that if you looked at your annual effective tax rate, right? If we went back to this slide, our annual effective tax rate for this company, we know is going to be 800 times 40%, or 320, over 480 is 67%. Right? So if the year turns out to be like we think it's going to turn out, we're going to have a 67% tax rate. And it's because our foreign losses are significant. But they don't want you to just take 67% times 150, because what you'll indirectly be doing is benefiting this $50 loss. And imagine a scenario where this was zero and instead this was 400. So if that was the case, and you applied a 67% rate to Q1, you would actually show a big benefit in Q1. And FASB was sitting there thinking, well, that doesn't make any sense. The whole point of country A is they don't have a tax provision, and now you just booked a 30 benefit. So to prevent you from indirectly doing that, they've said, well, let's just pull out country A and just deal with them totally separately, and so there's no risk of that. Okay? Whether the reader is really well served for this, is another question, but that's the policy reason behind the accounting rule. All right, you with me on that? That might seem esoteric, but this comes up a lot. And oddly enough, I was just working with a company, or I am working with a company now that is a relatively new client of mine. They missed this issue. And
Public?
it's public, yeah. And as I was talking to the tax director, it had never occurred to her that this was even possible. And she had never had it explained to her, basically. And to me, I'm like, are you kidding me? Like, this is like Twilight Zone. Because this is pretty pervasive. I mean, you see this quite a bit. But if this person's been at this company for 10, 12 years, and then if she hasn't been applying it, and no one's told her about it, and she's dozing off at the seminars,
Yeah, but what about the whole, what was it like, who was the auditing team on the other side?
I'm not going to tell you. It was a Big Four firm, though. So, but like I said in today's panel session when we were talking, like one of the issues I covered, I said, it's the type of thing where if you see this, you'll never forget it, And that's kind of like this paragraph 22A rule. Like if it happens to you, you'll never forget it. The problem is if you're sitting in a seminar and you're like, that's not me, I'm going to check email, right? You'll absolutely forget it. But that's how your provision experience grows, You suffer through the pain of dealing with these rules and realizing how unusual they are and how you don't want to get caught out by surprise again, and then into the little, bank of things you won't forget they go. That's how it works. Sure.
What if you don't have, so same scenario, you have one jurisdiction with taxable loss, but you don't have a VA because you don't have historical book loss in that jurisdiction. And then your PBT just happens to be very small. So now you're winding up with a really weird rate. Can you just treat that jurisdiction as a discrete, like just instead of taking it out of your annual UTR? I have a big full firm who's trying to do that. We think it's not right. Because you don't have a VA on it, so your benefit, you are picking up the benefit. But, yeah.
So let's just kind of play the. I assume you guys will have more fun playing that kind of thing out versus doing another class exercise. So let's just play that a little bit. Hold on a second while I get my Excel skills going here. Okay.
I think there's maybe a lot of review of this spreadsheet.
I think so.
What do you mean? I was going to throw this out.
So real well.
Okay, so let's. Okay, so tell me what you want your facts to be, Carol. So we're in two countries.
So, okay, so country A has PDP of, let's say, 100.
Okay.
Country B has a loss of 80.
Okay.
But country B will have a taxable loss of, well, 80, yeah, so it'll have a taxable loss of, let's say, negative 200.
You have a taxable loss of negative 200. Sorry,
That's a large perm deduction.
oh man, now you're making it hard. Okay, so let's just say that it's in-book income. Let's not say it's a perm, if that's okay. Or is the perm important?
It's the perm that's driving the weird rate.
Okay.
They have a really large...
Just for you, Carol, we will make it. Okay, so we're going to say there's a good guy perm.
Yeah.
Okay, so we're going to, let's...
Make it very big. Let's say 300 or 400.
Oh my gosh, that's huge. Okay. Okay, 10% tax rate, or do you want to change that?
40% tax rate.
So same as country A.
Yeah, and then country A changes to 15%.
Okay.
There you go.
Pretty soon you'll all get to bill Carol's client in a minute. It's going to be awesome.
Not as bad. Mine's negative 7,000 right now.
Okay, well let's make sure, we're not ready yet, trust me. So let's make sure we got the facts right. So in country A, we expect an income of $100 and a 15% rate, so that's $15 of tax. So for the year, we would expect a 15 provision for country A, right? Country B, we're going to lose 80 bucks, but there's also this favorable perm item, like tax-exempt interest or something. I know that's not that, but let's say that it's that. So in fact, our taxable loss for the year is going to be $380. So if we had $380 of book income plus perms, and we multiplied that by the tax rate, we would actually have a 152 benefit for the year for country B. Right? Okay. So that means for the year, I mean, let's just assume that this is all ordinary and normal, and this is just this company's fact pattern. Okay? For the year, there's going to be 20 of annual PBT globally, and the provision benefit is going to be $137, right? Which means my annual effective tax rate will be a negative 685%, right? And so what Carol, I think, is saying is, okay, so let's say that in Q1, my income was $100, right? So what should be my Q1 provision? Should it be that I just take $100 times a negative 685% and get a negative $685 provision? Right? Which is a little wild, right? I'm booking a gigantic provision that is way in excess of what my annual provision is. And the reason is my Q1 income looks a lot higher than my annual income. Right? Something weird like that.
Yeah.
Right? So these things happen, right? I mean, I always tell people that it's better to make a ton of money or lose a ton of money, right? It's not good to be like close to zero, because this is the type of problem you get into, right? I mean, if in country A they were making $2,000, we wouldn't even have this conversation. But because of just the nearness to zero in the denominator, everything looks crazy. So a lot of times, and we haven't covered this in the class, but I mean, there's a general rule that basically says, and this is actually in paragraph 22b. So you think all the business is happening in the 22 section, right? And you might be right, because there's some good stuff there. So 22b basically says, if in a jurisdiction you can't reasonably forecast, pull it out and do it separately. Okay? And what they mean by reasonably forecast is, well, if you changed one of these variables in a relatively modest way, this tax rate is going to swing all over the place, right? So even if you said, you know what, it's not 300, it's 250, well, now your tax rate went from 685% to 585%. So that's a pretty wild swing, right? You just changed your tax rate by 100 basis points. So in that situation, somebody might say, you know what, I can't reasonably forecast, so that this ETR is something I can, put ring fence around within some kind of reasonable parameters, right? Because just that small change moved it 100%, right? Or, if I said, oh, that 80, that's probably not 80, I think that actually might be 90. Well, now it's 1,200%. So because of the nearness to zero, some people will look at 22b and say, because small changes in my assumptions make wild changes in my effective tax rate, I'm not putting it in my ATR. I'm just going to say, country B, you're no fun. I'm taking you out. And I will just deal with country B on a discrete basis every quarter. And that's a totally reasonable way to apply that. And I don't know your situation, obviously, but my guess is that this is what the company's afraid of, is that in Q1 they would book it as, 585, and then you get to Q2 and they're like, oh no, I'm going to have $99 there, and now my rate is 12,000%. And you're going to say, well, I just applied 12,000%, it's just math. But I say that just math jokingly, right? There's an outer limit to which it just doesn't make any sense, and you have to come up with something that's more helpful to the reader. Does that answer your question?
Yeah, that's very helpful. Their argument is just because this number looks weird, they're going to just exclude it. But I think your explanation makes sense in the sense that they cannot estimate.
Yeah, they're trying to say 22B. They may, I don't know who they are, but
Yeah.
that's what they're trying to say probably. Yeah. Okay. Let me move my slides. Okay, so it's 9:30, and I'm going to spare you that last in-class exercise. I'd tell you to do it for homework, but I would just laugh all the drive home that you were going to do it. Okay, so this slide right here, this slide and the next two just have a bunch of examples of what's rate versus discrete. So if you care, and if you're listening to this conversation and you're like, this is interesting, I want to know with a little more detail what we're talking about, you can scan that on your own time. It's pretty straightforward. But remember that general rule I said of, if it impacts current year, it's probably a rate item, and if it impacts something other than current year income, it's probably discrete. That's a pretty good general rule of thumb. Okay. Now for next class. So the next class is international taxes. And I know you've only taken the class this first time, but I've taught it many times. And I've changed up the presentation materials for this whole semester. And the next class is actually one I've never taught before. And so, and I still actually need to do the slides. So over Thanksgiving, I'll be working on your slides for class 10. But we'll cover the basics of international tax, okay, and how it impacts a provision. International tax and provision, those are like the two hottest areas in tax. If somebody came to me and said, well, what should I specialize in because what's in demand, I would tell one of those two things. And if you know both, that's just off the charts. That's a great skill set to have. Companies are oftentimes recruiting international tax directors, and they'll say, I want them to know provision. And I'll just be like, let me know when you find one, But there are some out there, and boy, that is a great skill set to have. And at the TEI that I'm going to speak at in a couple weeks, I think we're going to talk just about war stories of big international tax type mistakes I've seen on provisions, and just tell stories about how companies have gone wrong in that topic. But what we're going to cover in next class is just the basics to get you interested in the area. And the homework is, this is pretty unorthodox homework. So in September, Congress held hearings on the topic of international tax planning by large public companies, and specifically technology companies. And the purpose of the hearings was to basically challenge what companies are doing to minimize their U.S. tax liability. And when you think of the big technology companies in the world, and you look at their effective tax rates, they're low. Okay? And they're low because they know how to move profits from high tax countries to low tax countries. And if you're a congressman, you're thinking, well, we don't like that. Right? And so these congressional hearings were focused on international tax policies generally from a U.S. tax perspective, but they also highlighted two companies, and the heads of tax of both those companies testified in front of Congress about their companies, their tax structures, and how it impacts their ETRs. And So the first item, which I don't think we emailed out yet, but we will email, is the bullet at the top of this page, which is the Senate report. And this is a great read. I mean, if you don't know much about international tax and you want to understand the very big picture of how tax planning professionals deal with tax laws to minimize U.S. tax, this is a great document to read, because it is written by someone who's probably very proficient in tax, explaining it to somebody who is in Congress, right? And I'm not saying they're dumb, I'm just saying if I'm in Congress, I'm not an expert in all the things they deal with, right? And what they basically explain in about a 30-page document is how large technology companies structure themselves to minimize their U.S. tax. And it's pretty accurate. It's high level, right? It's not in a roadmap where, oh, I'll just do that and then I'll be done. But in 25, 30 pages, you really get a good feel for what companies are doing to minimize their U.S. taxes. And the second angle to that is this APB 23 link. And APB 23 basically says, and I know we've talked about this briefly before, but it says, look, if you're not going to repatriate your foreign profits and pay U.S. tax on dividends, you don't have to accrue that either for financial accounting. Okay? So like Don was saying earlier, he has this indefinite reinvestment assertion. That's him saying that if I have money offshore profits, I'm not accruing U.S. tax on it because I don't ever plan to repatriate it. And what Congress was basically saying is, well, this accounting rule is motivating companies towards bad behavior, basically, from their perspective. It's motivating companies to park money offshore and not bring it back to the U.S., right? Because companies are very focused on not only cash tax savings, but also financial accounting. And their argument was, boy, absent that rule, companies might move cash back and forth into the U.S. and stimulate the economy. And that may be very well true. I don't know. But if you read the report, you'll get a really good idea of, if you're a person sitting in Congress, kind of what you think of all this. The second link is actually the video, which was the testimony by the two tax execs. One, the head of tax at Microsoft, and the second being the head of tax at HP. And the head of tax at Microsoft is his section starts around an hour and a half into the video, and the head of tax at HP starts at about 2 hours. And I know you're thinking, I'm not watching that, but it is very cool. Because when you think, gosh, do tax people like make it to the big stage? This is pretty big stage. And if you're at all intellectually curious, watch it and imagine you're one of those two guys, right? What would you say? And about 3 weeks or so ago, I spoke at a panel group that those two guys were at, and we talked basically about the same topic. And I mean, I'm completely empathetic to them, because as much as I joke around in class and stuff, you can't joke around in front of Congress, right? And you can't say the wrong things either. So I would strongly encourage you to watch the video. Arguably, it'll be better in class. And what they do, which is really interesting, is after they get done with the testimony by the guy at HP, then they have testify the equivalent of me for the audit firm for HP. And so they basically say, okay, we just heard the guy from HP tell us how he's minimizing his or U.S. taxes. And so you think this is okay from an accounting perspective? You're good with this? You're the auditor, you sign off on this? And it's pretty awkward, right? So if you watch it with the kind of empathy in mind that, like, what if you were one of those people, what would you say? It's an interesting way to watch it, because it's a tough situation.
So does the accounting person get to bill for that time?
I don't know. I don't know. I don't think any of them really enjoyed the experience.
Yeah.
But sometimes I think if you think about it from a deeper perspective, the idea was there's a lot of discussion amongst the politician about corporate tax reform and whether the corporate regime, the way it stands, should change. And this testimony was largely to show, I think, to Congress more broadly, that the current structure isn't working anyways. So for large, sophisticated companies, they have found a way to largely avoid U.S. tax. So if that's the case, well, why don't we just reform it? Because we're not really losing much. And in the Senate report, there's a table, I don't know what page it's on, but it's a table that summarizes like the 10 biggest companies with offshore profits. And if you add up the number, it's like, I want to say three or four hundred $400 billion or something like that of profit that is sitting outside the U.S., not subject to U.S. tax. The companies are like, nope, I'm not paying that back. Which it's just some enormous, crazy number.
That's a very unfamiliar role for a person in tax, right? I mean, they don't even really get involved in conference calls and stuff like that, too. They just pretty much give the information or try to put it out there for like the CFO to relay the information.
It depends on the company. You know, I work with a couple of companies where tax is very sensitive, right? Like Amazon. I mean,
Right.
yeah, tax gets pretty gnarly there. But HP and Microsoft, you'll see at in the testimony if you watch it that it talks about how they volunteered to be part of this, and I'm not sure if that's the true sense of the word volunteer, but I think in some way, and I say this just guessing, that they probably were okay being part of the discussion around corporate tax reform and knowing this was part of it. And my guess is they didn't appreciate the jabs about how they're like unpatriotic and that sort of thing. But again, you know, if you have any intellectual interest in the topic, what's interesting about it is they take an accounting concept like APB 23, and instead of thinking of it as this mechanical thing that you learn in class and apply a rule, they're thinking of it as that is changing behavior of large companies that's influencing, like, you know, major economic events. And that's a pretty interesting cause and effect, right? One accounting rule that companies use to manage earnings per share is driving this whole tax policy discussion, right? And so that's the vein in which you should watch it. In addition to, you know, can I empathize with the people in the people giving the testimony? So if I were you, I'd watch between like an hour and a half and 2.5 hours. Watch for an hour. I think it's pretty cool. When I was watching, I couldn't put it away. So. Okay, and then read the Microsoft 10K, and if you read the report and you watch a little bit of the video, by reading the Microsoft 10K, it'll kind of pull it all together. Okay, and then we can talk about them. All right, see you next class.